Hey option traders, for today's trade we're looking at a covered call strategy on Arista Networks. So looking at ANET on MarketSmith, shares have managed to move higher amid the broad market pullback over the past few days. The stock broke out past a 140.91 cut-based buy point on February 14th. Shares pulled back soon after the breakout and even triggered the 7 to 8% sell rule, but did not undercut the 21-day moving average. An alternative entry exists at 145.27 as well. The stock has since found support multiple times at this level and continued higher. ANET has several excellent IBD ratings, including a perfect 99 composite rating and a near perfect 98 EPS rating. The stock's RS line has also shot straight up over the past few days, which is a bullish sign. Shares are now extended from the 5% buy zone as well, which is this blue shaded area. The stock does not currently pay a dividend, but with today's covered call strategy, investors can create some yield on the stock. A call selling strategy is a great place also to start for beginners with options. A covered call is designed to collect income while also defining a predetermined exit price at which you'd sell the underlying stock. So say you buy 100 shares of a stock. Covered calls can allow you to lower the cost basis of the long position via selling a call against your position. As the seller of the call option, you're obligated to hand over your shares to the call buyer at the agreed upon price or the strike price, if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. Any appreciation in the stock above that strike price represents a profit for the call buyer. But if the stock instead declines in value, the buyer would have no reason to exercise the right to buy it for a higher cost. So in this case, they'd likely just allow the contract to expire and lose the premium paid. So with all of that said, let's take a look at my trading dashboard and set up a real-life trade in ANET.
Buying 100 shares of ANET would cost around $15,250. In addition, a January 19th, 2024 expiring call with a 160 strike can currently be sold for around $21.
Buying 100 shares of ANET would cost around $15,250. In addition, a January 19th, 2024 expiring 160 call option can currently be sold for around $21. This would generate $2,100 in premium per contract and provide an annualized yield as well. Just to emphasize this point, we are going much further out in time than usual and choosing a contract that expires in early 2024. If ANET closes above 160 on the expiration date, the shares will be called away at that price. The risk to the downside with this trade is that ANET might continue dropping, which could wipe out any gains made from selling the call. Covered calls are a fantastic way to generate extra income from a stock holding, while also providing some downside protection. Investors would need to weigh the pros and cons of the stock before initiating the trade, as you are considering buying 100 shares. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money, and remember that options are complex and investors can lose 100% or more of their investment in some cases. And be sure to check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And as always, join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.